Our money man is here. Happens to be a big-time Yankee fan. Doug Flynn from Flynn Zito Capital Management. So, all right, I feel like it's more interesting to talk to you than one of the baseball writer or something about this, because it makes sense. Steve Cohen's the owner of the Mets, right? He's a hedge fund manager.
Yep.
He's worth
He's
worth $20 billion. Those are the reports.
Correct.
Is this just something he's doing because he can, or can you make sense of this because over time he wants to build up the area around his stadium and the value of the franchise goes up if they win? I mean, does it make zero financial sense and he's just taking a flyer, or how do you view it?
Well, I think he has the ability to spend more money on something like this than, let's say, even the Yankees, because the Yankees, their whole thing is centered around the team. That their net worth is tied to the team. This is just one of the assets of Steve Cohen's fortune. The Mets are worth about $3 billion of his 20-something billion. So, the big issue here is that the Mets have lost money the last 4 years in a row as he spent on all these contracts.
Apparently, he doesn't care necessarily about that year to year.
$650 million has been spent already in losing money. And so if you're worth $20 billion and you can afford to spend $650 million in a losing organization and continue that, baseball allows it more than others because there is no salary cap. It's just you pay the luxury tax. In this case, he paid over $100 million in luxury tax, the highest ever. And it's all about wanting to win the World Series. Now, I will say, Soto was on the Yankees last year with arguably one of the best players in Judge, and they didn't pull the World Series. So there's no assurances of anything.
No, they got there, though. They got to the World Series.
They got there. Right. And there is some revenue pickup when you do that. When you go to the World Series, it's estimated that your team might make $50 million, and this could drive ticket sales and advertising. So he'll make some of this back, but it's going to be an ever-increasing loser on the front part if they don't, certainly if they don't turn it into a World Series, which is the goal.
I'm sure he's thinking, I don't know what he's thinking, but like other assets he owns, he probably thinks about when he's going to sell them, but I don't think he thinks about that with the Mets.
Not with the team. I mean,
his wife would be like, what are you doing? We got $20 billion. You're going to sell this team I love?
Exactly.
So, I mean, he isn't thinking it that way.
Sports teams don't really do better than the market. It's just a trophy asset that you want to have, and it's fun, and certainly this is important to him. So we'll see how it goes once they put it all into play.
That's right. I just wanted to force you to do the segment because I know you're a big Yankee fan, and then the Mets getting this guy was kind of funny.
Yeah, we've moved on. We've already moved on.
Oh, sure. Well, good luck with that. Yeah, it's being that small market team in New York now, as you have to adjust. Let me talk about your big day. It is Tuesday after all, and that would be Tax Tip Tuesday. We have about 2 minutes to run through this. Go Tax Tip 1 to get to the end of the years on lowering your taxes. So rounding up deductible expenses. Let's start there.
Sure. So really what happens is the vast majority of people take the standard deduction, which for a married couple is over $29,000, which just means that unless you have itemized deductions for more than that, you're just going to opt for the standard. However, if you're close to that, you think about bunching up your expenses, maybe doing more charity or looking at your medical expenses and trying to put them all into 1 year. Like instead of December, maybe moving into January if you think you can get close to that next year. Or if you had a lot of expenses this year, pull them into this year, pay those expenses so you can get them up so that you can switch to itemizing. That's something you just want to look at before the year escapes you. So that's what we're doing with rounding up at deductible expenses. And a real tip and trick for that you want to look at for new homeowners is that a lot of new homeowners, when they close, they close at some point in the year and haven't gotten all of the real estate taxes paid in for the year. Now, under the current laws, you can only deduct up to $10,000 of property taxes and local taxes. But if you closed a couple months ago, you might only have a couple thousand of property taxes paid. You can prepay your next year's expenses to a degree if you have a January, February bill and pull that into this year and boost up your deductible expenses. So that's a great way to look at right before the end of the year there.
Very good. Last thing, and we'll put it up, is that you can take advantage of tax breaks depending on who you are. For example, an educator or a student. Quick final thought on this.
Yeah, educators. These are for the people who don't itemize. You're already not itemizing, but you still can get a deduction as an educator for $300 worth of out-of-pocket expenses. And if you're an undergrad student or a parent of an undergrad student, you have the American Opportunity Tax Credit. If you make less than $160,000 as a married couple, that's $2,500. And remember, credits are much more valuable than just deductions. And lastly, grad students look to the lifetime learning credit. You get 10% of your first $20,000 of grad expenses. $2,000 max. So look at that. Take it off your taxes.
Next Tuesday, we'll help Juan Soto with his taxes here in second year in New York. Just with a different team. Thank you, Doug. Closing bell.